Super cool. All right then. Today, guys, we are having awesome. It's going to be awesome. Webinar with Leon Rowe. Leon's up there with one of my oldest original students, Leon Emmanuel. He's actually on the call as well.
Oh, Em's on the call.
Brilliant. Yeah, there he is. And yeah, Leon basically took my ideas. I actually had a few drinks with Leon. Me and Leon's met up a couple of times, become friends. And he took my ideas and basically developed them into his own sort of process, and has taken that and been able to become profitable as a trader consistently over a long period of time, trading his ideas. And one of the big things that Leon's really good at is identifying certain levels that have more gravitas than others, and hopefully we're going to learn about that today. So Leon,
yes,
over to you.
Thank you, mate. Much appreciated. So supply and demand Forex trading. I'm sure many of you have heard about supply and demand trading, and I'm going to be basically just giving my take and my ideas and thoughts and how I've been trading supply and demand. It's different from what you tend to see online and on YouTube. So the agenda for today is going to be determining value, because without understanding value, supply and demand just won't work. It's basically just like trading support and resistance. You have to have a directional bias, and in every asset class that you're buying or selling, you really need to know how to determine value. We've got DBR, RBD, or HHL or LHLL. Bit of a mouthful, but I'll explain that when I get to it. You've got drawing supply and demand zones on the candlestick price chart. So I'll go over exactly how I draw these zones on a price chart, what makes a good supply or demand zone, because not all supply and demand zones are created equal. And I'll be going over some live chart analysis and some trade examples. Support and resistance or supply and demand is a common question I get. What's the difference between them, if there is a difference? And I'll be basically showing you how to really kind of trade them together, and differences, and also the supply and demand equation. And that's basically to do with forced and willing supply and demand. So determining value. I hope everyone's can hear me. Everyone's okay still? Everyone's still there?
Yeah,
Roger.
All right, brilliant. By the way, if you want to, just chime in, ask me anything, please do, and because I don't want to leave anyone, behind if they're, if I've gone a bit too far, they don't understand anything. Yeah.
Yeah, well, mate.
Oh, brilliant. Okay, so first things first is, and I'm sure you all know this, but hello.
Someone's got their microphone open. Do you want to just shut your mics, guys? Just mute.
Yeah, mute it until maybe you're ready to, to ask a question. Yep. Okay. All right. So I'll continue on. And we know that pretty much the markets are run, the Forex market anyway, is run by the bank. And this is a Euro FX survey 2017. And basically, this is the top 10 overall market share of the banks, of basically the FX market, sorry. And the top 10 banks and their market share in 2017, and this was 2016. And pretty much you've got top 10 banks, Citi Morgan, JP Morgan, US, UBS, etc. Their market share overall is around 60% of the market. And then, everyone else is just, again, some other financial institutions and banks. So I say that because we are in their game. We're in their field. Retail traders make up something like, maybe 6-7% of the Forex market, even though it's a massive market. it's something like 4 trillion, 5 trillion or something like that. And even if, 7% of that is still a lot of money. But these are the guys that basically create the price on a price chart. So these guys aren't looking at, candlesticks and certain levels, if they are looking at certain price levels, but they're not looking at, basically like price action. These guys are creating the price action. So what are these guys looking at, right? If they're looking at making decisions on buying and selling, it can't just be technical patterns they're looking at. There's got to be something beyond the price chart that they're looking at if they're the ones creating the price action. So that leads us to fundamentals and really determining value. And what the financial institutions do through fundamentals, well, in my opinion, there's 3 main reasons for the... Hello, is everyone there? Hello?
Hello, yeah, still here.
Okay. All right, no worries. Yeah, sorry. It's just that what happened on my screen, like your name's just kind of dropped off the side of my screen, so I thought something had happened. No worries. So I'll continue. In my opinion, there are 3 main reasons why the market moves. One is fundamentals and sentiment, which is basically value. You've got risk sentiment, which is basically where you have financial institutions and money will flow into safe haven assets like, for example, gold, government treasury bonds. In the Forex world, it's the Japanese yen and the Swiss franc. When risk is on, basically meaning that everything is all good with the world and investors have got risk appetite and they want a bigger return, they'll go into higher yielding assets and higher yielding currencies regarding interest rates. And that would be, for example, the dollar and commodity currencies like the Australian dollar, New Zealand dollar, Canadian dollar, etc. Right. And then you've also got liquidity, and liquidity is to do with stop hunting. If there's not enough, buy or sell orders, the market will seek those orders, as we know. But when it comes to fundamentals and value, these are the main 3 things that we need to look at: is GDP and the business cycle. So financial institutions, again, will invest their money in a currency and in a country that is in the, for example, expansion or boom phase, rather than putting their money into a country that is going into a contraction or recession or bust phase. Inflation and inflation targets. Central banks have got a 2% target and they really want to get to that inflation prices target. And the way that they can do that is via interest rates and the interest rate cycle. And not to get into it too much, but if you do want to, learn about any of these, or if you want to touch up on your fundamentals and really how I trade the fundamentals, there's a link. Take a picture if you want. And that's pretty much it. But fundamentals and determining value is what we need to do, right, when it comes to our directional bias and buying strength versus weakness. Anyone got any questions or anything like that?
Yeah, I have. So,
what's up?
So value, what you're saying is that once you've got like your fundamental direction, but by understanding what a central bank's doing with interest rates and where you're in the business cycle, you're essentially saying that value would represent something cheap within that context. Absolutely
cheap. We're looking for cheap. We're looking for bargain prices. That's pretty much what we're looking for. We're looking for cheap and I kind of focus on what's a bargain price is. I try not to look at what is potentially expensive. It's easier for me to look at what is a bargain price from GDP, from inflation, from interest rates and inflation, etc., and what's really, the value. That's what I'm looking at.
Right. So how that would play out on a chart is it would look like a bag of spanners as it's going down against whatever currency, but ultimately in the backdrop you have that broader understanding that this is actually this is an opportunity. This is not
right.
Negative.
So for example, we would look at, for example, maybe the dollar yen, right, would be a great example, or any kind of risk off currency where it strengthens based off of basically just some sort of economic uncertainty, political uncertainty, or interest rate, but some risk of sentiment, basically. But if you're looking at the Japanese yen from, or for example, the Swiss franc economically, and where they are in their interest rate cycle, or where they are with regards to inflation targets, they're terrible. But risk sentiment or risk off sentiment, where money will flow into the Swiss franc or the Japanese yen, making it stronger, what that does is it brings price to a certain level when you want to buy the dollar. And what I'll do is I'll probably explain it better on a price chart. Let's go to dollar, right? Risk sentiment was, can everyone see my chart as well?
Yeah.
Yep. So risk was off, so money was flowing into the Japanese yen. When risk goes back on, the Japanese yen, if you're looking at it fundamentally, is basically worse than the US dollar. So risk sentiment, what it does, and risk off sentiment will drive prices to where we want to be buyers of the US dollar, because we know at this price level, right, when risk comes back on and when fundamentals are in play and when investors want a bigger return on their money. So for example, the Japanese yen, their interest rates are like minus 0.1 or something like that, compared to the dollar where you're getting, 2.5%. Where's the money going to go? This is an absolute bargain. Does that make sense?
Yep.
Yeah.
If it doesn't make sense to someone, just let me know.
Yeah. So basically, imagine it just as like an individual. If you're on a high street and you've got an opportunity to put your money in two banks, one has an interest rate where they say we're going to take money off you for putting money into your account, or you can put it over here on the other side of the high street and you can get 3% interest. Where are you going to put your money?
That's exactly it. And that's risk on. When risk is on, when the fundamentals are in play, that's what you're seeing pretty much, develop in the market. Risk sentiment and risk off sentiment drives prices to where we would want to be, and can drive prices to where we want to be buyers, and where a level is cheap, right? And we'll go into this, basically this trade, for example, on the dollar yen a bit later as well. So technically and fundamentally, what we want to look at is business cycle, inflation and interest rates, and determine what is the stronger currency versus the weaker currency, and then look for example, if we're looking to buy the dollar yen, you'd be looking for just demand zones, and those would be areas of value. Make sense?
Right. So you're having a bias, and then you are only trading in that direction.
That's exactly it.
Cheap prices, right?
Yeah, at cheap prices. And technically, I'm going to show you exactly why the areas of demand logically in my head, and how I kind of figured out the levels. And I'll show you that pretty much in a diagram, as far as I'll draw it out for you guys.
Leon?
Yep.
Are you going to give us a demonstration of how you actually figure out the sentiment and the fundamentals? Like go into a website and do you put it in a spreadsheet, or?
I actually have a spreadsheet. I actually do have a spreadsheet, and it's for the basically the traders that I do mentor, but I will show it to you.
Right.
I will show it to you. It was created by a trader. I'm not sure if he's in the room. I don't think he is. Shane. I invited him, and I don't think he could probably make it. Our Fitz is here. And we kind of sat down, worked out what we want to look at. And over the past, I would say, maybe 2 months, 3 months, the fundamentals have actually really kind of played out. And I'll show you the spreadsheet as well.
Cool, thank you.
All right. Remind me actually at the end, matter of fact, yeah? Ian?
Yeah, sure, we'll do, mate.
Yep, no worries, mate. Okay, so RBD, DBR, or HHHL, LHLL. Basically, when everyone thinks about supply and demand, they think about rally-based drop, drop-based rally, right? That's what pretty much everyone is told. And so you've got basically rally, base, drop. And then what happens is that if prices come back up to this area, that's where you want to be a seller. And then you've got drop, base, rally. And then when prices come back down to this area, this is where you're supposed to be a buyer. So you're looking at imbalances in supply and demand. So demand, and then you've got the imbalance takes place right here. And that's where traders are looking at. And then you've got rally-based rally. So for example, if you get a situation like this, it'd be rally, base, rally, and then the imbalance in demand. So there's more demand than supply here, and then you'd wait for prices to come back down and then look for buy trade. And same thing with drop, base, drop. Now, again, I don't think there's necessarily it's just basically a way of, or the way that I looked at supply and demand, and what kind of made more sense to me in the context of things like fundamentals was higher highs, higher lows, and lower highs, lower lows. So what I realized is that if you get a move up, right, this is going to be demand, and this potentially when it starts to pull back is going to be supply. Now, we know this to be true because obviously buyers, there was demand for price. If this is a price chart, self-evident. Now, we know that this is going to be the cheap area, and this has to be an expensive area simply because prices couldn't go any higher. Buyers were no longer interested at whatever this price level was. Now, from this low to this high, this is expensive and this is cheap. 50% of this has to be what I would call fair value. So whenever we get pullbacks, and this is basically what Fibonacci is. Fibonacci is just, discounts, pretty much 32%, 61% is just a discount on what is cheap and what would be considered expensive. And so what I realized was if prices start to come higher, and this is going to be an expensive area, right? This level here is an expensive area. If prices continue to push past this, what would be considered an expensive area, then this has to be a strong level of demand. This has to be considered an absolute bargain at this price, because as prices were going higher and higher and higher, this could have sold off, but it didn't, and it carried on going through. So what I realized was that this has to be a strong level of demand, right? From a technical analysis, from a fundamental, perspective, prices, I guess, are really kind of uncontrollable. That's the reason why, I guess inflation and the central banks try to control inflation, try to control prices. But if we get, for example, a sentiment, play, or we get, let's say, a pullback, this has to be, with my logical opinion, if you're looking at this being the absolute bargain and this being the new expensive area, the best place to buy is not at a previous supply zone now turned into support that would be considered resistance, right? That can't be the best area to buy. yes, we know as far as technical patterns are concerned, this is what people do, but from a higher probability perspective, here has to be, because it's proven to be an absolute bargain in the same way that this low to this high was proven to be a bargain expensive. This is the low, this breaks past the previous expensive area, new expensive area. So this from here to here has to be the strongest area of demand, and this is going to be, your supply level, providing fundamentals are still in play. And this is, and I did a video on this on YouTube, and it's called like the complex pullback. And also as well with if anybody's ever traded things like Gartley patterns and butterflies and stuff like that, or cipher patterns, and what these patterns are. For example, with the complex pullback, traders will get long here, right, thinking that this is past resistance, should turn support, and then what happens is they end up getting cream there because they see some price action, and then they put their stop losses there, and then what happens is they were buying at fair value or thereabouts, maybe just above, maybe just below, but it wasn't the best place to buy, which was a proven demand zone, the strongest area. This is where the start of the move occurred. And then what happens is they get lower highs, lower lows, and trend traders, and everybody's taught to trend, to chase the trend. And what is, a trend? In definition, lower highs, lower lows is going to be the start of a new trend. Not realizing that the start of the move, the best place to buy was actually right here. So what happens is they end up waiting for a pullback, right? No idea about fundamentals either. They end up getting short here, stops above the high, and then prices end up getting them twice. And then they say, trend trading doesn't work. What's going on? Blah, 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 right? We're buying at levels of demand. We have to, because it's proven. Remember, that this is where the banks were buying. The banks that proved that this is where they were buying in the past. And if the fundamentals are still the same, negative sentiment can just push prices to where we want them. We want to be a buyer, and this is cheap. This is value because it was proven value in the past.
Yeah, can you just say on that as well?
Yep.
Like, when was the last time any of us created an engulfing candle?
Yeah. Yeah, exactly.
Right, we just don't do it. It's not us doing it. So whoever was in charge of moving that price from that level to
exactly
to there is obviously huge.
That's exactly it, and that's why I did the Euro money, because just to prove the point that it's like 10 banks that run, that have a 60% market share. They're the ones. They're not looking at price action. Yeah, they're looking at something beyond the price. What is it that they're looking at? And it has to be, things like fundamental sentiment, whatever it is, that they look at as far as liquidity and that. And then this is where we want to be buyers. And traders who trade, for example, Gartley patterns and that X to A to B leg, and then they draw that pattern there, and then it's the B to C, C to D, and it usually ends around here. They're just buying into a demand zone. There's no logical reason for, these Fibonacci patterns. It's got to hit this and it's got to hit that. It's just when prices come down to this demand zone, all they're taking advantage of is what would be known as the X leg, which is the strongest area of demand proven. In the same way that if this is supply now, that is supply, this has to be an expensive area, right? So when prices come up to here, it's proven to be expensive because there are no buyers anymore. Again, obviously, depending on fundamentals, etc. But if we were looking to get short on this, and we were waiting for prices to come back up, right? It's proven that this is an expensive area, or, for example, a cheap area for the quote currency. And this is where we would want to buy the quote currency, because we know that this was an absolute bargain. Prices fell away. Something must have changed, maybe sentiment-wise or fundamental-wise. When prices come back up here, this is where we want to be sellers, because it's proven to be an expensive, or, in the case of, Forex, I try not to look at anything being expensive, but just this is a cheap level for the quote currency. Everyone follow along?
Yeah, cheers, mate.
Makes sense?
Yeah, super interesting.
Are you going off the daily chart with this? Is this what it's meant to be on?
Sorry?
Is this meant to be the daily chart?
Yes.
Level?
Yes.
Yeah.
So I look at daily levels. I definitely look at daily levels. So I'm looking for proof of value, right? Proof of value is always in my mind when I'm looking at, demand and supply zones. And again, with rally-based drop-based rally, the emphasis is more on just looking for imbalances in supply and demand. I'm looking for proof of value. And higher highs and higher lows are proof of value. Expensive, prices break through. This is going to be the demand zone. That's going to be the demand zone. All right. Prices don't break through now. In fact, if prices fail to go higher, then yes, there is demand here, but is it a strong level of demand? Can that be considered a strong level of demand if it can't push past the expensive level? It's a decent level of demand, but you want the best areas of demand. Proof of definite 100% value is if prices go past what would be considered a previous expensive level. And this is where you want to get long.
So you're looking for levels where price puts in new highs and lows and ignoring those that don't.
Exactly.
Got it.
Well, I wouldn't say 100% ignoring, because there's always, exceptions to the rule, and, depending on, the fundamentals. I will definitely still trade levels where you do get, demand that will go up to probably the expensive area. Again, depends on the risk reward. But the majority of the time, I'm looking for new highs and then pullbacks into demand.